right, let's look at unearned revenue. So these are advances from our customers. A customer pays us in advance for services or merchandise that we've yet to provide. That's a liability to us. We now have an obligation to provide that service or merchandise or return the customer's money. Good example here, it says when an airline sells a ticket for a future flight, you pay in advance for that, and until they actually perform, meaning you actually make that flight, that's a liability for them. Same thing when an attorney receives legal fees. The next example here is a football game. So in this case, if Superior University sells 10,000 season football tickets at $50 each for its 5-game home schedule, they debit cash for the amount of money they collect in advance. Go ahead and credit the liability on unearned football ticket revenue for the $500,000 until they actually play a game. Once they play one of those 5 games, then they get to debit the unearned football ticket revenue, which is the liability, and credit the actual revenue. Here's an example. Let's go through together. So this says Travis Publishing Company completed the following transactions. They sold 40 6-month subscriptions collecting cash of $1,500 plus sales tax of 5%, remitted the sales tax to the state of Maine, and then made the necessary adjustment at year-end to record the amount of subscription revenue earned during the year. So this is kind of a compound problem. We're going to do sales taxes and unearned revenue. So let's look at that journal entry on the on September 1st. So we sold 40 6-month subscriptions. We got $1,500 in cash plus 5%. Well, what is 5% of $1,500? Like $75. So we will go ahead and debit our cash for the $1,500 plus the $75 in sales taxes. So our customers paid us $1,575. Going to go ahead and credit unearned subscription revenue, the liability here, for $1,500. And then for $75, we'll have sales taxes payable, that liability that we owe the state now. Okay, then let's go ahead here on the 15th and we'll remit the sales taxes back to the state. So that will be a debit to sales taxes payable for $75. The reason is it was a credit when we collected the money that increased our liability. By debiting it, we're going to decrease the liability by the same amount, $75. So we're going to get rid of that off of our books, and then we'll credit cash here for $75. That's also going to decrease our cash account. And then we have here on the 31st, we're going to show how much revenue has actually been earned from those subscriptions. So this was September 1st. So we have September plus October plus November plus December. If they're monthly subscriptions, we now have 4 months worth of subscriptions that we can show as being earned because we had sent those out. So we're going to debit the liability, unearned subscription revenue here. For $1,000. And that $1,000 is the $1,500 divided by the 6 monthly subscriptions, which is $250 a piece, times the 4 months that have expired. So there's where that $1,000 comes from. And then the credit will be our subscription revenue because we've now earned that. We've sent out those magazines for 4 months. We've earned that revenue, so we want to record it as such so we can put it on our income statement as revenue. So our subscription revenue will be debited then for $1,000.